All right. Looks like we've got enough on here to go ahead and get started. So I want to welcome everybody for being here and joining us for this today. It was something that Archie had done a couple of weeks ago now, but it was geared more towards really any type of business that wasn't specific. And then after that, we had quite a few requests to have Archie do this, but specifically for and tailored to your micro small businesses, which we obviously have a lot of here in Sumter. So I want to thank everybody for being here. Archie, thank you again for donating your time. For those of you that are not familiar with Archie, I just want to do a quick bio on him and tell you a little bit about him. Archie Parnell was born and educated in South Carolina, and after graduating from USC Law School in Columbia, started his tax career at the United States Department of Justice in the tax division. Thereafter, he was on the staff of the Ways and Means Committee of the House of Representatives. He left the U.S. government and entered the private sector in the tax departments of two different U.S. multinational Fortune 100 companies, one an oil and gas company and the other financial services. These U.S. companies sent and kept him overseas, where he was an active member of the American Chamber of Commerce in Hong Kong, Brussels, and Tokyo. Throughout, Archie and his family maintained a home in Sumter near his parents. He has taught international tax law schools in the U.S. and abroad. He's currently chair of the Sumter County Bar Association's ad hoc COVID-19 Help Committee, which provides help on a pro bono basis on COVID-19 legislation. So, Archie, again, thank you very much for joining us, and I'm going to turn it over to you. Real quick, everybody, if you would put all of your microphones on mute. Once Archie finishes his initial presentation, we will go to a question and answer segment, and then you can unmute yourself if you have a specific question or comment for Archie. So Archie, floor is yours.
Thank you very much, Chris. I'm going to now share my slides and just get straight into this. Let me see if I can do this properly. Where did it share? Okay, now I think I'm getting there. Okay, good. This, as Chris said, this is an overview. It's a summary of some tax changes that were made in response to the COVID-19, and its focus is not on all businesses, because this legislation that was enacted covers everything. And I'm just going to pull out the tax provisions that apply to either companies with just a handful of employees, micro businesses, which are generally defined as businesses that have 10 or less employees, as well as focus on sole proprietors as well. And so that's what this presentation is about. Now let's see, how do I go down? Oh, there we go. Now I want to at first say a couple of disclaimers, and they're pretty important, really. And I'm making this presentation, but I am not your accountant or your lawyer, and I do urge you, if you have any follow-up questions, I'd be happy to answer them. There's a website, an email address that I can give you, that Sumter County Bar Association that I can give you, but you really should touch base with your own advisors to understand these rules in your specific circumstances, because everybody is different, and the differences sometimes are very, very important and have different impacts on different taxpayers. The other thing I want to say is that this information is changing all the time. And even now, there's still a lot of unanswered questions out there. And I'm going to just keep this at a high level. I'm not going to hopefully get into too much detail. I have to tell you at the start, however, I am prone to getting in the weeds. I am very prone to going down rabbit holes. And if I do, Chris, please tell me to stop, because I can get into minutia too quickly and stay there. So the agenda for today, I have it here. It's to talk about the federal tax response, what's happened to date. And in broad terms, there are tax deferrals, tax credits. There have been earlier limitations on certain tax items that have now been suspended. And in addition, there's some other things, like you can now have early withdrawals from retirement accounts without having the penalty incurred. And you can also make charitable deductions and have them deductible up to $300 and still claim the standard deduction. And then I'm going to end on some controversy between Congress and the IRS on forgiveness of PPP loans. So, so there have been a number of acts of Congress and other actions in response to COVID-19. The first one was an Appropriations Act back in March the 6th. That was followed when President Trump declared a national emergency. And then on the 18th of March, there was the first Corona Response Act, the family's first Corona Response Act. And then also on that same day, on March the 18th, under the Stafford Act, which was when President Trump declared the national emergency, the IRS used that authority to delay the certain deadlines, payment deadlines and so forth. And then 2 days later, the IRS further delayed filing deadlines. So now the filing deadline that was April the 15th is now July the 15th. And I suspect some of you may have heard that Secretary of Treasury Mnuchin is thinking about using his authority under the Stafford Act to delay it until September, but that's just chit chat. Right now, the returns have to be filed by July the 15th if you haven't done so already. Now, the big piece of legislation that has most of the items that I'll be talking about today is the next one on March the 28th, the Corona Aid Relief and Economic Securities Act, the so-called CARES Act. And that established the Paycheck Protection Program, changed a lot of the tax code. And then about a month later, because of the caps on the Paycheck Protection Program had already been reached, they were renewed on April the 24th under the so-called Paycheck Protection Program and Healthcare Enhancement Act. And then after that, on June the 5th, the last piece of legislation that's been out there to date is the Paycheck Protection Flexibility Act, which in effect extends what was the 8-week period for the PPP up to 24 weeks. And of course, we don't know no one ever knows what the future is. And there are other measures that are being discussed at the moment, but and there will likely be some. And whenever you turn on television, some part of it will be about the coronavirus, and some part of it will also be about the response, the additional actions taken by governments. Now, what I've just said, just those few, that one page just before, there's a lot of information in there, and it's overwhelming, quite honestly. And what I'm going to try to do is sort of boil it down today and describe just certain provisions in there that could be helpful. And I think that the photograph of this young lady is quite apropos to anyone confronted with such overwhelming information. So the first thing that I'd like to talk about is a tax deferral, and that is a tax deferral of Social Security tax payments. And this applies both to employers that have employees as well as to self-employed people. Now, if you're an employer, you have to withhold on wages that you pay to your employees. Part of that withholding is income tax. Another part of that withholding is Social Security tax. The employee pays his or her share of Social Security tax, and the employer pays his share of the Social Security tax. Likewise, if you're a self-employed person, you pay both the employer and the employee Social Security tax in order to get social quarters of coverage for Social Security. And so this deferral of Social Security tax payments applies both to employers as well as self-employed people. And what it is that you can delay the deposit of the employer portion, just the employer portion, which amounts to 6.2% of wages paid for all employees between the dates of March 27th through the end of this calendar year. Now, one of the things that you're going to notice during this presentation is that there are lots of different dates involved here. Some provisions have different dates, but generally speaking, and there are exceptions with everything in the tax world, but generally speaking, what I'll be talking about today are tax rules that apply this year in 2020 in response to COVID-19. So you can delay the deposit of the employer's portion, the 6.2% of wages for all employees for wages between March the 27th through the end of the year. Likewise, a self-employed person can delay the CECA, that acronym stands for Self-Employment Contribution Act. And so that the self-employed individuals can delay the payment of 6.2% of their Social Security tax liability. This deferral does not apply to the federal unemployment tax, and so or the Medicare tax, the employer share of the Medicare tax, the 1.45%. Now, when you delay this payment, it's not a forgiveness. It's just a delay. It's not a tax credit. It's not a forgiveness. This is just a deferral, and so you have to pay 50% of the deferred payroll tax that you've delayed back by the end of 2021, and then you have to pay back the remainder at the end of the following year, December 2022. Now, one caveat that needs to be pointed out here is that you can defer your employer's portion and the CECA portion of this Social Security taxes up through the end of this year, except if you've gotten a forgiveness of the PPP loan, and if that occurs, then you can no longer defer the Social Security tax payments. And so that, what I've just talked about, is tax deferral. This means that you can ease your cash flow problems. Instead of depositing and paying over the employer's part or the 6.2% of the self-employed part of Social Security tax, you can wait, and you'll have all the way until the end of 2021 and 2022. So it's to ease cash flow problems. The next topic that I'm going to talk about is a tax credit, which means that it's a dollar for dollar credit against tax liability. So it's more valuable than a tax deferral, because a tax deferral you have to pay back eventually, or pay eventually, and a tax credit is something that offsets your tax liability. Now, you cannot. This employee retention tax credit is designed to retain employees during the pandemic, and so you can't. But you cannot get this credit if the employer is also received the PPP. And so if you've received the PPP, you might want to tune out for the next couple of slides, because this slide, I think, is quite important for those people that do have employers on their payroll, even a handful of employees on their payroll, if they've not received the PPP. And there are lots of people out there like that. Now, what this is, this employee retention tax credit, is that it's a refundable tax credit. And refundable, I'll go through an example in a minute, but refundable means that if your tax liability is less than the tax credit, and there's more tax credit than there is tax liability, the IRS will refund to you the excess amount of the tax credit. So if your tax liability is 20 and the refundable tax credit is 50, then you would not pay the 20 tax, and in addition, the 30 of the 50 would be refunded to you by the IRS. So it's a refundable tax credit. Some tax credits are not refundable, so that's an important point to make here. Now, what it is that it's 50% of wages, and now I'm talking about different dates already, that are paid between March the 13th to the end of this year. And it's a credit of up to $5,000 per employee, and there's no limit on the number of employees. So if you have an employee, and I'll go through the numbers, and there's a tax credit when you go through the calculations of $4,000 for that employee, and you have another employee that the tax credit is $5,000, your total, and you have those two employees, your total tax credit would be $9,000. Now, this employee retention tax credit is only available for eligible employers. And that's a defined term, and I put it in quotes. And it really means that those employers that have been adversely impacted by the pandemic. And so the next slide shows what this is. It's an either/or test. You can be an eligible employer either if your operations were fully or partially suspended by a governmental order. And we've got lots of businesses that have been closed because they were not allowed to open during during part of all of this period. Now it's lifted here in South Carolina, but there was a time when things were closed. Not all businesses were classified as essential businesses. So that's one test. But even if you were an essential business and you were not ordered to close, you can still be considered an eligible employer if you've experienced a significant decline in gross receipts. And there it's just a mathematical test. And it's whether or not you've lost more than 50% of the revenue compared to the same quarter in last year. And from that point, when you've lost more than 50% of revenue from last year, up to when you get back to 80% of revenue compared to the last quarter of last year, you can claim the credit for wages paid during that period. Now, I want to point out that this employee retention tax credit is for employers that have employees. It does not apply to self-employed individuals. And so I just want to make that clear. The payroll tax deferral that I talked about earlier this morning does apply to self-employed, but this employee retention tax credit does not. But for those people that it does apply to, and you do not, and you've not gotten a PPP loan, this is money that you need to claim because it's money that you will get back, assuming you meet the qualifications. And the other point I want to make is that this is for this credit is only for wages that are paid during the period of suspension or the period of significant decline of gross receipts. But for those people that's adversely affected like this can be a meaningful amount of money. Now, so how is this retention tax credit calculated, and how do you get it? And so, unfortunately, I can't read my slides because it's hidden by the attendees. I hope you can read them, but I wonder if I can change. Well, I can do that later. But if you assume that an employee is paid $60,000 in 2020, and also, and that means, I guess I can't read this part of my slides. That means $5,000 a month, and receives health insurance that's paid by the employer, costing the employer $500 per month. And if you assume that there was a significant decline of gross receipts for the second quarter, and so this would be, an essential business that was open, but nonetheless had a significant decline of receipts. In other words, had a 50% drop of receipts from the second quarter in 2019. So if that's the case, the retention tax credit calculation would be on these assumptions: the $15,000 plus the $1,500 because it's for the quarter. So it's 15,000 wages, 1,500 for health insurance. So 16,500 of eligible wages, and you multiply that times 50% because you can't claim 100%. The rules say it's just 50% of eligible wages. And so that would mean that for this employee, the first step would say that you'd have an $8,250 employee retention tax credit. But remember that the credit is capped at $5,000 per employee. So that means in this example, if there was only one employee then the employer could claim a $5,000 tax credit against the employer liability that's reported on forms, either on forms 941, it's an IRS form when you pay your withholding, when you pay over taxes that have been withheld, or this new form 7200. And again, this is the last bullet point on this slide. If there is a this is the refundable tax credit. So if it exceeds the employer's payroll, then the excess is refunded by the employee, by the IRS to the employer, and hence it's a dollar for dollar credit. So in this particular case, this example, this $5,000 would either mean that the employer does not have to pay $5,000 of payroll taxes, or if his payroll taxes was less than that, he would nonetheless receive a total of $5,000 by having a decline in the amount of payroll taxes that he or she would otherwise pay, as well as have the excess amount refunded to him or her. So again, this is an important thing. You're only eligible if you have employees and you were adversely impacted as defined, and only for the period that you were adversely impacted by the pandemic. You're not eligible, however, if you've taken a PPP loan, and this rule applies even if the PPP loan is not ultimately forgiven. You nonetheless, the way these words are written, you would not be able to take the retention tax credit. Likewise, you can't claim it if you are self-employed. So I urge you folks out there that are listening to this, if you think that this might help you, please call your payroll service provider and see to apply if you're eligible, because you can apply whenever you need to file that form, that 941. So it's not, you don't have to wait till next year. You get that reduction of your payroll liability now, and you get that excess amount refunded to you now. And that's obviously very good for cash flow. So the next one is another tax credit, and it's the sick leave and family leave credit. It doesn't get very much talked about, and I'll go through this quickly. It was enacted by the very first act here. It was on that list that I gave earlier, and it applies to all small and mid-sized employers to pay sick leave and family leave. Now, you remember the name of that act was Families First, and so the focus here was not on employers or anything like that. It was on families and people in the families who got sick, families that had to stay at home because their children couldn't go to school, and all of that sort of thing. So this said that employers had to pay, this is not a tax point, but had to provide paid sick leave and family leave to employees. And it was 80 hours of sick leave for anyone that had to quarantine, and up to 12 weeks for family leave to care for a child whose school or child care facility was closed due to the coronavirus. This law is effective through the end of the year as well. This is a 2020 rule. Now, unlike a lot of the labor laws that are out there in the United States that talk about if you are an employee with less than 50 employees, some rules don't have to apply to that sort of business with fewer than 50 employees, and that's why a lot of employers, it's been reported, sort of manage their employee groups to never get to 50. But here it does. This rule of requiring that employers pay family leave and sick leave applies to any business that has employees. But realizing that this could be quite a burden to very, very small businesses like micro businesses, there is a rule that says you can be exempted from this rule. But it's a kind of funny thing, because it says you have to be an authorized person and you have to write and retain in your business files the statement that paying this leave or tax credit would jeopardize the viability of the business. And that's language from the Act. So in order to not pay this, you have to take this step of saying it would jeopardize the viability of the business to pay it. And so that's out there. And you may have seen that there have been some lawsuits that have been brought here in South Carolina on this particular act of people not getting the sick leave and family leave. I've read about them in the state newspaper. But so this obviously would be a cost to employers, and so there was a refundable payroll tax credit, somewhat like the employee retention tax credit that I just discussed, but a little different and more narrow. And it's designed to provide employers that have to pay this sick leave and family leave with the funds to pay it. And so that's what this is about. So if you go to the next slide, the tax credit is up to 80 hours of paid sick leave for 100% of normal pay. And the maximum is $511 per day. And then likewise, family leave is for 12 weeks, but at 2/3 normal pay, and the maximum is $200 a day. I don't know, I haven't heard anything about this here in Sumter. But as I say, other parts of the state, I've read that there are lawsuits that are going on where people are claiming this sick leave and family leave from employers. But remember, if you're an employer and you think you have this issue, and you think that this, and you in good faith think that this would adversely affect the viability of the business, you should write that on a piece of paper and stick it in the file. I know that sounds awfully silly, but that's what the rules say. So the next thing that I'm going to talk about are certain suspension of limitations of various tax rules. There are a number of things out there where you can't claim 100% of it. And so what these CARES Act changes do is that they increase the percentage of something that you could otherwise not claim. And so, for example, net operating losses, the Tax Cuts and Jobs Act, that was a 2017 law that was enacted that cut the tax rates, the corporate rate, from 35% down to 21%, and it did a lot of things. But it forecast terms lost a lot of revenue. In order to make up some of that revenue, there were provisions in that act that were seen to be revenue raisers. Probably one of the more significant that you've heard about is the limitations on the deductibility of state and local taxation. That was severely limited, and so people in high tax states like California and New York complained a lot about that. But another provision of the Tax Cuts and Jobs Act that increased revenues was that they changed the rules of claiming net operating losses, so that beginning in 2018, you could only carry net operating losses forward and not back. Also, the Tax Cuts and Jobs Act said you could only offset 80% of taxable income when these net operating losses were used. Now, the CARES Act that was enacted in March changes these rules back to the prior rules, and so you can carry them back, and you can claim 100% of these losses against taxable income. And so it's a significant point if you do have net operating losses. And again, that's why in the beginning of this, I asked that each of you talk to your own advisors, because each of your facts will be different. Some of you may have net operating losses, some of you hopefully don't, but so if you do, this is something that you need to know about. Now, if you're self-employed, and the Tax Cuts and Jobs Act as a revenue raiser capped the amount of net business loss that could be used to offset other income, was capped at $250,000. So we're talking about big numbers here, but under the CARES Act, that was that was changed so that you can do it 2018, 2019, and 2020. And then starting January 1st of next year, all these prior limitations go back into force. And so it's one of the reasons why tax law is so complicated, because it changes all the time, and then you have to look back and changes just for a little bit of a period, and then it changes again. And so these changes are quite difficult to keep track of, and also difficult to understand sometimes. Now, another one of these suspensions of limitations is on the limitation on the deductibility of business interest expense. Another revenue raiser of the Tax Cuts and Jobs Act was that business interest expense was limited to 30% of adjusted taxable income. And that rule started January 1st, 2018. But the CARES Act changes this rule so that the 30% limitation is increased to 50%, so it allows a larger deduction in 2020. But again, this limit falls back to 30% starting in 2021. What I've been talking about so far has been sort of the business side of this, namely Social Security withholding, paying sick leave, net operating losses, as well as deduction of business interest expense. Now what I'm going to talk about just briefly is turning to the individual side and seeing how that could help some people with cash flow problems. But this is an individual tax point, and that is, if you put money away in a qualified retirement plan, you cannot withdraw that until age 59 and a half without incurring a tax penalty. And those rules were put in place a long, long time ago. And it's to encourage people to save for retirement. And so realizing that a lot of people were going to have cash flow problems, the CARES Act did say that if you need to dip into your retirement savings, you can do so in 2020 without reaching the age of 59 and a half and not be subject to the 10% withdrawal penalty. This is limited, so if you have a lot of money in your retirement account, you could only withdraw $100,000 in total per person, not per retirement account. So if there's someone out there that needs cash for cash flow, and they need it in order to keep the business afloat or keep themselves afloat, this is something that they should consider. Obviously, it's a very tricky and difficult decision to make, because retirement funds should, more generally speaking, and it's a more prudent thing generally, to keep the retirement funds in your retirement plans and not withdraw them early. But my only point for bringing this up is that there is this change by the CARES Act that allows individuals to withdraw money from retirement accounts without incurring the tax penalty. And so the other individual point that I want to make, and this is more not so much business focused, but rather focused on encouraging those good deeds that people do. Charitable activities. We now know that only about 9 out of 10 people, I'm sure I put it the other way, 9 out of 10 people, more than 9 out of 10 people no longer itemize on their tax returns, and instead they use the standard deduction. The standard deduction was increased substantially by the Tax Cuts and Jobs Act. And it used to be that if you gave contributions to your church or to other charities, if you itemized your tax return, you could claim those deductions against your income for tax purposes. But given the fact that the standard deduction is larger, more than 90% of people no longer itemize, and instead, and as a consequence, don't deduct the charitable deductions they make during the year. The CARES Act now allows an individual to deduct cash donations. I have to emphasize cash. This is not giving clothes away or furniture and things like that, but cash to a charity of up to $300 on their 2020 tax return, even if they do take the standard deduction. And this is designed to encourage people to be additionally charitable in these difficult times. And so married folks that have filed jointly can get this deduction of $600 and still take the standard deduction as well. So that's something that I thought I should point out, because it's not something that you read about, and it may make somebody's a little easier to pull some money out, or if they do pull some money out and give to their church, that they keep a record of it, or have the church give them a record of it so that they can then claim it on their tax return in 2020. So the last thing I want to do before I open it up to questions is to talk about a controversy that's still ongoing between the IRS and Congress, and that is the CARES Act specifically excludes the forgiveness of a PPP loan from taxable income. So without that rule in the CARES Act, loan forgiveness is seen to be, generally speaking, a taxable income, because if you have a $100 loan and $90 of it is forgiven, so you don't have to come up with $90 to pay that loan, the tax law typically says that $90 of loan forgiveness is considered taxable income to you. And so the CARES Act specifically excludes the forgiveness of a portion or all of the PPP loan from taxable income. People thought that was a great thing, very, very generous. But then in April, the end of April of this year, the IRS, in one of their notices, said that borrowers are not entitled to deduct costs that are covered by a forgiven PPP loan. So you'll recall that the PPP loan was designed to pay, in effect, wages as well as some other expenses, limited certain expenses. And so what the IRS said, if you did that and that loan is forgiven because you've met those rules, then you will not have taxable income from the forgiveness of the loan by virtue of this CARES Act provision. However, you're not going to be able to deduct the wages that you've paid because of another provision in the Internal Revenue Code that the Congress didn't know about when they were enacting this CARES law, or they ignored when they enacted this CARES Act forgiveness not being taxable income provision, which says that if you pay expenses from tax-exempt income, that's not a deductible expense. And so that provision, paying expenses with tax-exempt income, has been in the law for a very long time, decades. And so the IRS, after this CARES Act came up, sort of said to the Congress, "You have a foot fault here. You didn't quite get it all right." And so we're charged with administering the tax law as it is written, and therefore the PPP loan, when it's forgiven, will not be exempt taxable income and will be exempt from taxable income. However, any expenses paid from that with respect to that forgiven loan will not be deductible. And so that caught a lot of people by surprise, because a lot of people thought there'd be kind of two benefits here. You'd get the PPP loan for free, if you will. In other words, you get the money, you'd spend it for what it's supposed to be spent for, and then it would be forgiven. And then in addition to that, you'd be able to deduct the expenses that you paid for with the PPP loan. And so you'd, in effect, have two benefits there. But the IRS put a kibosh on that. Now, the chairman of the Senate Finance Committee a senator from Iowa, Grassley, who's a Republican, and a Democrat, Richard Neal, who's chair of the Ways and Means Committee, immediately got together. This was a good thing that two sides getting together and said Congress did not intend to deny the deduction of ordinary and necessary business expenses. And so they've written that letter to the IRS and to the Treasury Department. They have it in hand. And I think what the IRS is now sort of saying, well, if that's what you intended, you should have put it in the law because the law is pretty clear and you have all kinds of opportunities to legislate. So the next time you do something on this topic, you should make that part of the law, that you can deduct expenses paid by forgiven PPP loans. But the Congress hasn't gotten to that part of it yet. And they have enacted a law subsequent to this controversy erupting when they enacted that law on June the 5th. And so who knows what's going to happen here. But all it does mean is that there's a bit of a mess here. And that's why the slide was designed with that little splat on it, a yellow splat, just sort of saying there's some controversy here. So with that, that's all I have. I want to thank you for joining this. And I've got the world wearing a mask here, and I invite any questions that anyone has. Thank you. Thank you so much for listening.
If anybody has any questions, just unmute your microphone and.
I think I put people to sleep.
You must have done a fantastic job in covering everything. You answered everybody's questions.
Or I put people to sleep, one or the other. But I do urge people to if they've heard anything in this presentation that they have questions about and they prefer to ask them, privately or something like that, send me an email. The email link is on the Chamber's blast about this. I'd be happy to try to answer them if I can.
Yeah, that email address is sumpterbarcovid19.help@gmail.com.
Right. And that I'll be happy to.
It can also be found on our website in the marketing of this particular webinar. Right. Okay, last chance. Does anybody have any questions for Archie?
I urge you to talk to your tax advisors because there's something in here for most businesses to take advantage of, and so it's not just PPP loans that are out there, or the economic injury disaster loans, or whatever that acronym was. I mean, there are some tax items out there that can help, and so please talk to people that know about this stuff so that you can take advantage of it.
That's a good point. And Archie, I'm sure that there's probably going to be some more changes that come down as we go throughout the end of the year after July 15th with the new tax deadline. So I'm sure we'll talk and possibly do another one of these or a couple of these later on in the year for people. And but we greatly appreciate you doing this once again for us and appreciate your time.
Thank you. Thanks, everyone.
Thank you, everybody.
Bye-bye.